listen, we have some pretty worrying trends like the unemployment rate and delinquencies and defaults are all rising. Those tend to be secular trends when they begin. They don't stop because the Fed cut by 50 basis points. This is the time when the time that the Fed is cutting now happens to be the first time in history we have a problem with inflation and we have an insolvent government. And the Fed's rate cuts were well telegraphed. So the longer duration bonds already priced in. The bond market has already priced in the Fed's rate cuts. When the Fed started cutting rates, the 10-year note was 3.6%. Normally, the 10-year note is about 5% plus.
In today's news recap, analysts predicts silver prices could reach $200, driven by demand for new EV battery technology. A financial expert with over a decade of experience in commodities markets has predicted that silver could reach $200 per ounce in the next 10 to 15 years, riding the wave of increased demand for a new EV battery technology developed by Samsung. According to Bambro, the new batteries may require 1 kilo of silver per car, driving silver usage sky high. Bambro believes that the precious metal will be able to reach $200 per ounce prices, supported by the emergence of a revolutionary new electric vehicle battery technology that uses silver in its structure. The new solid-state batteries developed by Samsung feature a silver carbon composite layer for the anode, allowing them to have an increased life, dramatically reduced charging times, and larger operating longevity. According to his estimates, each battery cell might require up to 5 grams of silver, putting the whole requirement for an average car battery at 1 kilograms. Bambro assesses that if only 20% of the yearly global car market adopts this kind of battery, 16 million EVs, it would increase silver demand sky high. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hit the like button, and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
I'll go to a few $1,000s an ounce. Because, and I don't know why I went down this road. You have to forgive me. But, gold, AU, comes from exploding stars. And it's an element in the Earth's crust. It's very limited. And you can't create any more of it. It can't be created. Okay? It's beautiful. And it's virtually indestructible. And it's extremely rare. However, cryptocurrencies are based on blockchains, which there are unlimited numbers of blockchains that can be created, where this ledger, digital ledger, or a coin can ride along. So they're not unique. I don't care if there's 21 million units of Bitcoin, because there's thousands of cryptocurrencies that trade that do pretty much the same thing, right? So I'm finished with my diatribe there. Go buy yourself some gold. And listen, I don't sell gold. I'm just saying that if you believe, like I believe, that real interest rates are falling and nominal rates will be capped because the government is insolvent and they can't afford to pay interest on the debt, which is why Mr. Powell lowered interest rates in the first place, then you need to buy gold. They can do that. And they did it with ease because we had a deflationary problem, or at least according to the minds of the government, we had a problem. We can't seem to get to 2% inflation. If only we can get to 2%, because, 1.9% doesn't really work. The economy can't function at 1.9%. This is how they think. It's crazy. So, but now we have a problem where inflation, and you look at this morning's, I don't know when this is going to air, but we look at this morning's ISM services report, showed that inflation is a real problem for corporations. It still is. So the Fed can very well cut interest rates to 0% to bail out the stock market. They might not like the reaction because interest rates on the long end of the curve, which the Fed does not control directly, they would have to actually go and buy those bonds. They're controlling the money market rate by the Fed funds rate. They have to go some massive QE program to buy long-term debt, U.S. Treasuries. which would be hyperinflationary. I'm not saying they won't do that, but they're not doing it now. They're supposedly doing QT, and you could have interest rates spike out of control, which would destroy real estate, would destroy the stock market. So the Fed funds target rate is 4.5 to 4.75 right now. If they can cut to zero, they can cut to negative, especially if we have a digital currency, a CBDC. They can cut to negative, negative 100% if they wanted to. They just say, put your money in the bank, and the interest we're going to charge you is 100%. You have nothing left, so you better not put your money in the bank. You better just spend it. That's what they could do. I mean, I'm using hyperbole, but they can cut rates to zero. They have a lot of room left to go. What would happen to long-term interest rates? What would happen to commodity prices if they did that?
In today's news recap, silver price rises to near 31.50 due to rising geopolitical tensions. Silver price extends its gains for the second consecutive day, trading around 31.50 per troy ounce during the European hours on Wednesday. The upside of the silver prices is attributed to the safe haven flows amid escalating geopolitical tensions in the Middle East. Iran launched over 200 ballistic missiles at Israel on Tuesday, shortly after the U.S. had warned that a strike was imminent. The Israel Defense Forces reported that several of the missiles were intercepted, according to Bloomberg. On Tuesday, the weaker than expected numbers made room for the U.S. Federal Reserve to continue lowering rates. The index came at 47.2 for September, matching the reading with August's print, but came in below the market expectation of 47.5. However, Fed Chair Jerome Powell said on Monday the central bank is not in a hurry and will lower its benchmark rate gradually over time. The CME FedWatch tool indicates that markets are assigning a 62.7% probability to a 25 basis point rate cut by the Federal Reserve in November, while the likelihood of a 50 basis point cut is 37.3%, down from 57.4% a week ago. Prolonged higher interest rates keep the opportunity cost higher of holding non-yielding assets like silver, making it less appealing to investors who seek more attractive, yield-bearing alternatives. Silver demand has been bolstered by China's fiscal and monetary stimulus, particularly benefiting industrial applications in one of the world's largest manufacturing hubs. However, weaker than expected demand growth in China, compounded by data indicating a decline in manufacturing activity, might have limited the upside potential of the gray metal. Now we'll show you the best clips of the latest interview, but first smash the subscribe button and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
So I'm not net short the market right now. I don't even have any shorts at all except for a very tiny short in high yield. It's my only short that I have. But I'm long India, working out well. I'm long gold. I actually bought some silver recently. That's, I think that's on the verge of a major breakout. I own utilities. We own all kinds of things here because it's not time yet. My model is built, my inflation, deflation, economic cycle model is built as a timing tool. But just because it hasn't triggered me to get net short the market doesn't mean that I'll never have to get there. Because like you said, these problems are extant and they haven't gone away. They're only getting worse. The debt continues to pile up. Corporations are issuing more and more debt. If you look at total non-financial debt to GDP, it's at a record high. The government is insolvent, 720% debt to revenue as far as the Treasury is concerned. That is incredible to me. Our deficits are $2 trillion per annum in supposedly good times, right? In times of full employment. So there's huge problems that have just they haven't come to the surface yet, but they're festering underneath. And when they come to the surface, it's going to be a huge, huge problem. Because at the end of the day, I believe in mathematics and genuine economics, and I believe in reality. And the reality is that home prices are about 40% higher than what they need to be affordable to the average American. Home price to income ratios are that much out of whack. And the same is true for the stock market. It's about 50% overvalued if you look at the total market cap of equities as a percentage of the economy. So these things tend to mean revert. If you believe in mean reversion, then they're going to happen. It's taking longer than even I would have thought, but who cares? I mean, there's just so much liquidity out there, and the Fed and other governments keep trying to delay the inevitable. But you can't delay the inevitable. I mean, in the national course of listen, let's just take an example. I'll give you a perfect example if you're confused about what I'm talking about. Let's look at Japan. Japan has a quadrillion yen in debt outstanding, and the bond market. If the bond market in Japan, if JGBs was reliant on tax revenue to finance the debt, their interest rates would be double digits. However, that can't happen in Japan because the Bank of Japan raised interest rates to 0.5%, and it caused chaos in the global markets because it was an unwind of the yen carry trade and markets were flushed down the toilet. The Bank of Japan can't even raise interest rates to 0.25% to 0.5%. But that's because the Bank of Japan owns almost all of the government bonds, a vast majority of JGBs, Japanese government bonds. So this is what we're heading into. So in reality, the 10-year note has no darn business trading at 3.7% or 3.8%. No way. Not with inflation just ending 9% and an insolvent government and $2 trillion deficits. No way. So without the Fed's balance sheet being now $7 trillion, without the Fed's put out there, interest rates would be much higher, which would bankrupt the country because we have so much debt. So the Fed has to print money, but if the Fed prints money, you get inflation, and that means bonds have to rise. Bond yields have to rise. So it's catch-22. And that's what happened. This is not a new phenomenon. This is what happened in every country that has went bankrupt in the past, which you print money to make the debt solvent, which causes inflation, which causes interest rates to rise. So you have to print more money, causes hyperinflation, and you destroy the economy. I mean, that's where we're headed.
What do you think of Pento's take? Do you agree with him? Post in the comments section down below your honest opinion and share with the stackers if you think a major recession is coming in 2025 or not. Now watch this video right here because you'll love it, and I'll see you on the other side.